All right, so when an energy giant like Marathon Petroleum drops its quarterly results, it's way more than just numbers on a page. It's really a health check on a massive engine that, helps power the entire country. So let's dive into this and see what their latest report really tells us. We're going to pull back the curtain on Marathon's performance. We'll look at their core refining business, their big strategy for growth, and, of course, what it all means for the bottom line. It's a story about efficiency, smart moves, and, well, a whole lot of cash. And let's just start with the headline number, because, wow, in just a third quarter alone, Marathon Petroleum generated a whopping $2.4 billion in cash from its operations. That one number tells you pretty much everything you need to know. This was a very, very strong quarter. So how'd they do it? I mean, a number that big doesn't just happen by accident. It was the result of really solid performance across the entire business. So let's crack this open and look at the key highlights. Okay, this table really paints the picture. First, you've got adjusted EBITDA at a super robust $3.2 billion. Just think of that as a clean look at the company's core profitability. Then, they returned almost $1 billion to shareholders. And maybe most importantly, they boosted their dividend by 10%. That's a huge signal of confidence in the future. So, the heart and soul of Marathon's business is its massive refining and marketing segment. This is the part of the company that turns crude oil into the gasoline, diesel, and jet fuel that we all use every single day. Its performance is what really drives those big numbers we just saw. And that engine was absolutely humming. Their refineries were running at 95% of their total capacity, which is just incredibly efficient. But here's the thing that really got analysts talking. See the third bar? The capture rate was 96%. Now that's a great number, but it's a little dip from their year-to-date average of 102%. And that small change is what had everybody asking questions. So what on earth is a capture rate? Okay, think of it like this. The market says there's a certain amount of potential profit out there for turning crude into fuel. Let's say it's $100. The capture rate is the percentage of that $100 a company actually puts in its pocket. It's a direct measure of how good they are at playing the market. And this slide, wow, it just lays it all out perfectly. For most of the year, Marathon was capturing more than the theoretical maximum profit, 102%. But this quarter, it fell just a bit, to 96%. Still fantastic, but, that dip needed an explanation. So what happened? Well, the company came right out and said, hey, we knew this was coming. It wasn't one single thing, but a few key factors. They pointed to some market challenges, especially on the coasts, and some planned maintenance at a huge unit in their Galveston Bay refinery, which, get this, that one thing alone accounted for almost a 2% hit. But refining is only half the story. The other huge piece of Marathon's success is its midstream business, a company called MPLX. Think of this as the superhighway for energy, the pipelines, the storage, the whole network. And it has become an incredibly powerful and really predictable cash flow machine. And when I say cash machine, I am not kidding. MPLX is now on track to send $2.8 billion in cash back to its parent company, Marathon, every single year. That's just a massive, steady river of income. Now, why does this matter so much? This is the kicker right here. That cash flow is so big and so reliable that it's expected to cover all of Marathon's own spending on new projects and its entire dividend payment to shareholders. Having that kind of stability is a huge strategic advantage in the, up and down world of energy. So with that steady cash flow as a rock-solid foundation, Marathon is aggressively investing to make its business even stronger for the long haul. And we're not just talking about routine maintenance. These are smart, high-return projects and a constant optimization of all their assets. And check this out. They are not shy about the returns they're expecting. Look at these projects. They're modernizing their LA refinery for a 20% return. They're upgrading their Illinois refinery to make more jet fuel for a 25% return. And then this massive project in Galveston Bay is expected to return more than 20%. These are big, confident bets on future profitability. At the same time, it's not just about building new stuff. It's also about smart housekeeping. They sold off their stake in an ethanol business for a nice chunk of change because it just didn't fit their core strategy anymore. Meanwhile, they're using MPLX to snap up new, strategic assets that make their core business even stronger. Okay, so we've got a humming refining business, a cash machine in the midstream, and a bunch of smart investments in the future. Let's bring it all home. What does this actually mean for the people who own a piece of the company? In just 3 months, Marathon returned $926 million to its owners. Most of that, you can see, was through share repurchases. Basically, they're buying their own stock, which makes each remaining share that you might own just a little bit more valuable. The rest, of course, was paid out directly as dividends. The CEO, Marianne Monin, she really hit the nail on the head. She said their whole integrated and diverse business model allows them to lead the industry in how they spend their money and create value. It's just a really clear statement of their strategy and their confidence. So, at the end of the day, it all comes down to this one question. By combining a super efficient refining business with a stable, growing cash engine from its midstream unit, has Marathon basically built a formula for success that can win no matter what the market throws at it? It's a pretty compelling case.